Okay, we are continuing with example 4. We're on page 7, and we've just done the goodwill and acquisition differential calculation, so those are new little p's. And just so you can get it straight in your head, we did the entries on both Company A's and Company B's individual separate entity books, okay? So, moving to consolidation land, okay? So I just do this because students, as we keep adding on pieces, students get confused about, are we talking about Company A's books? Are we talking about just the consolidation? What happens everywhere, okay? So I'm going to say, just double checking that this is all just on consolidation land. Yes, it is. Okay, so now we're in consolidation land. Oh, and when you join the CPA, don't tell them about the land. We'll just pretend we use very technical terms. So, consolidation land, and I'm going to say on a separate laptop on Company A. At Company A. Okay? So you don't get confused and think you're doing it on A's books. So not on A's books. Can't stress that enough, you guys. And in fact, whenever you're doing any of this consolidation, I would stress to yourself, where am I doing this? Oh, I'm doing this on a consolidation land, on a separate laptop, not on A's books. Use whatever words to distinguish it from A's books. Because later we're going to be doing entries for A and entries for the consolidation. You've got to know which belong where. Okay. So first we're going to do the elimination entries. Consolidation entries. So basically what you're doing, it's kind of shown here. You're taking Company A and putting their stuff here, and Company B's and putting their stuff here. Then you do some adjustments as if you were actually purchasing the net assets and moving it together. So merging the two statements to get the consolidated balance sheet. And where's the consolidated balance sheet done? On Consolidation laptop. Not A's books. These are not A's books. Okay? So when we're doing these entries, they're not on A's books. So, remember, we're combining Company A and Company B. So the first step you have to do is eliminate A's investment in B and close off B's equity. So here's A, here's B, and this is not a technical word, mushing them together and ending them up over here. But we have one little problem, okay? You have two companies, Company A, Company B. We're merging them, and right now, Company A has an investment in B Corp. Well, if we merge them into one company, and A is the parent, okay? So this is the parent, the main one. Can A investment in itself when we merge these two together? Well, no, we've got to get rid of that because you can't, when you're combined, you can't have an investment in yourself. You're just the parent A and B's just kind of mushed in there with you. Okay? So we've got to get rid of this. That means eliminate A's investment in B. And over here, B has equity, common shares and retained earnings. Well, if they become part of us Do they have their own retained earnings and common shares? No. So we've got to get rid of these guys too. That's what we're doing with the first step. Books are we doing this on? No one's. Just on a consolidation laptop. It's just a worksheet. Okay? So, we need to close common shares and retained earnings of B. Okay? So, let's debit them because they're credit balances. B's common shares for $25,000. Debit B's retained earnings for $33,000. And note, if this had a deficit, not retained earnings, remember deficit is a negative balance, you would be crediting it. Okay, so watch out for things like that, you guys. Technically, you're supposed to know everything you learned from intro, and 315, and 316. And so sometimes you forget some of this stuff. So the more questions you do, the more of these weird little things you'll run into that aren't hard and aren't new. It's just they're part of all the accounts you've accumulated. Okay, so we close B's equity, so it's closed, got rid of it. We also have to get rid of this investment because we can't have an investment in ourselves. And now that we've closed B, there is no B. So to close that off, leave a blank line. We're going to credit investment in B for $95,000. Okay, so does that balance? No, you are off by $37,000. On page 6 and see if there's anything in your goodwill calculation that matches that. Yeah, your acquisition differential. Okay, so that's one of the reasons we've separated out. Plus, as we move forward in time through a year and an income statement, we need these numbers separated for other things. Okay, so the acquisition differential covers the carrying value of B's, assets minus liabilities equal equity, so that's what we've got here, and it gets rid of the investment. So now, if you look back on page 6, that was up here. Okay, so that was like our first entry. Second entry is dealing with here down. So this is your second entry. Yeah. Okay. So our second entry is write or mark the subs net assets to fair value and record goodwill, and that's from page. Okay, so from page 6, we are going to write the subs or B's net assets to fair value. So we're going to debit assets by $21,000, debit liabilities by $1,000, debit customer contract by $7,000, and debit goodwill by $8,000. Okay? And all those are going to match up to the acquisition differential. So we're doing two entries, one at the top and one on the bottom. Okay? And every chapter will do more. Okay. So let's start with, we had to debit assets for 21,000. And I'm just following down my goodwill calculation. Debit liabilities, 4,000. And of course, if it was a credit, you'd credit it. That's all. Debit contract for 7,000. And debit goodwill. It's all debits here for 8,000. And what do you guess that all adds up to? It should add up to acquisition differential or 37,000. So credit acquisition differential or 37,000. Okay, so let's get straight. These elimination entries are going to be done if you're using the working paper approach, because there's two different methods you can use. Do them here and then create your consolidated balance sheet by working. Okay? Now there's one thing I do want to point out about Connect. On Connect, Chapter 3, if they have the subs, revenue and expenses, before acquisition date, just ignore them. Just use parents, revenue and expense for consolidation. Oh, sorry, that's crooked, you guys. Okay, so on Connect for Chapter 3 questions, if they have the subs, revenue, and expenses from before acquisition. So let's say here it was December 31st and January 1st was acquisition. So they gave a statement from December 31st and it had all the revenues and expenses on it. They had a balance sheet and an income statement. Well, did we own them last year? No, we just bought them January 1st. So can we claim any of their revenues and expenses as ours? No, we didn't even that. Okay, so you just ignore theirs and put ours in. Okay? We will do revenues and expenses in great detail over the next few chapters. Okay, so what you do now is you take these two entries, which remember is just being done right here on a laptop or consolidation land or the working paper. Okay? What I want you to do is post these entries in here. So post them in. And then go across and add the different things. You can get a consolidated balance sheet. Don't forget, this contract and goodwill, it's not already there. So you're going to have to put them in. There'll be a space left. Yeah. Okay, so go ahead and do that. I'm going to go on to the next video.